Hello everyone, this is Sebastian McMahon from IA Financial Group. First, a happy new year to everyone out there, and let's kick off the year with the first weekly economic review of 2024. So let's start with a look at this week's markets at the close on Thursday. So only a few days in the books already. Markets are, let's say, without a direction as we start the year. Remember that 2023 ended with strong momentum. So there's maybe some give back here, especially in bonds. So negative returns year to date so far, minus 2.3% for the long index. For equities, it's more of a mixed bag. Interestingly, a strong week for the NASDAQ. The AI theme, big tech in 2023 was a very important driver of market returns. Let's see if it carries over into 2024. For commodity prices, I'm recording this before market open on Friday, January 12th, and because of some coordinated strikes from the US and the UK in Yemen, we see that this morning price of oil is up about 4%. The price of gold is sharply up also. So the picture here might differ when the week is said and done. So geopolitics remains an important factor here as a driver of returns. So if we maybe look forward first, if we look towards 2024 and 2025 for economic growth, just here to anchor the macro environment, we're looking at below trend growth for the next 2 years. We see that the weight of the tightening of monetary policy should hold economic growth back. The digestion of everything that happened during the COVID period continues. So there was a lot of money that was injected during the pandemic, and now this money is being drawn out. So people are using their savings to finance their consumption. At some point, those savings will run out. We're seeing the use of credit rise. We're seeing credit delinquencies also starting to rise. So there's many factors here that make us think that and makes the consensus here think that we could see slower growth over the next 2 years. So when you have below trend growth environments, usually that means more volatility coming from macro data. So when growth is strong, this can hide a lot of little issues. But when growth is slow, then you can have some volatile macro data, which causes some volatility in markets. But if you look at the details here, here this is a consensus from Bloomberg, and the interesting thing is that it's revised often, and you can see the move from optimism to pessimism in those charts. And if we start with the left chart, you see that as we've been approaching 2024, the expectations for Canada and Europe were getting dimmer and dimmer. Now it's 0.5% expected for 2024 for total growth, and in the US it's been revised higher, and now there's more optimism towards the US economy, and it's expected to outperform in 2024. And if we look at the growth of the US deficit, we had some data this week showing that the growth is still there. So as long as the deficit is growing compared to the deficit of last year, this is a tailwind for economic growth. There's going to be some payback at some point, but the short run, this is an engine of growth. You should have an outperformance in the US because of that. We also see that the US consumer is still pretty supportive, although, as I mentioned, it's winding down its savings, and we're starting to see some credit delinquencies happen. So let's see if it has some legs, but the US economy should outperform. If you look at the top of those charts, China expected to contribute, to grow by 4.5% in 2024, 4.3% in 2025. So China's economy is still growing strong, but it's contributing less and less to global growth. Looking at 2025 now, Europe is expected to still underperform, Canada and the US to be a bit brighter in terms of growth, but still this is all below potential growth. So this is the environment that we're stepping in. Looking at inflation now, this is the data point of the week. The fight is not done. Inflation in the US went a little bit higher than expected, and it ticked up in the chart. This is what you have on the left, and focus here also on the super core inflation. So this is a measure of inflation that takes out food energy and shelter. So it's really like the core of spending, and you see that this is still pretty sticky, close to 4%. So the fight is not done. And on the right, you see that some leading indicators, like here's the price plans over the next 3 months for small businesses in the US as the gray line. It suggests that, and it's a leading indicator, of course, CPI, it suggests that in the short run, yes, we could see some more downward pressure on inflation, but after that, it could start picking up, back up again. So this is going to be very important, because on the next slide here, you see that the expectations for what the Fed will do and the Bank of Canada will do on the right has been pretty dovish here. So it's pretty aggressive, pricing in 5 to 6 cuts in 2024. It seems excessive. To get that many cuts, we should, likely it's because we have an economy that is sliding into a real recession, not a mild recession, but a real recession. Our inflation is clearly under control, and both are pretty unlikely, according to us and according to the consensus of economists. So markets might be a bit ahead of themselves here, and look at how these forecasts were revised, more aggressively since October all the way to today. If you look at the blue line on the left for the Fed, it went from expecting 3 cuts. Markets went from expecting 3 cuts in October to 6 cuts now for the whole of 2024. That means that if we deprice some of that, we could unwind some of the returns that we had in the second half of 2023, or at least cause some volatility in the market. So expect H1 and H2 to be 2 very different stories in the markets. This is the message here. So when we ended the year, with sentiment that was near extremes. So on the next chart here, you see that on the left, those are both JP Morgan sentiment indicators. On the left, you have the equity sentiment, and on the right, you have the sentiment towards treasuries, and both were at extreme levels, positive. So usually when you reach extremes, you have, turnaround, and the turnaround can also have some legs. So this is one more reason to expect some volatility in H1. Doesn't take too many disappointing macro data points or just momentum exhausting itself for sentiment to start turning. So a point of caution here. Looking at valuations, here you have all of the regions. You have multiple methods of gauging valuations. If you concentrate on the focus on the median column here, you see that the TSX is pretty cheap, 28th percentile over 10 years. US is pretty expensive. Japan is on the cheap side. Small caps in the US, the Russell 2000 pretty much on median. Europe and Asia a little bit above median, but the weight of the US stock market is so large that global stocks seem to be pricey to start the year. So valuations tend to matter when there's turnarounds in markets, when sentiment fades, and here, of course, this gives a clear advantage to the Canadian stock market. Maybe just the last chart here, because it's a question I've been asked repeatedly since the beginning of the year. 2024 is off to a slow start, and should we care? Well, first, we saw that even this week with a positive return on stocks, returns are not negative year to date anymore, but we're close to zero. So we still don't know where we're going to end up. But let's focus here on the sticks that are on the right of the chart. January, okay? Because the first 3 days, 5 days, 10 days, it's less interesting, let's say. So when we'll be done with the month of January, what should we take away then? Well, the first stick at 39 here shows that historically January is down only 39% of the time. So 61% of the time, the month of January is a positive month of returns on the S&P 500. Now, if January is negative, then the average annual return of that year tends to be at minus 0.7%. And if January is positive, you tend to have annual average returns of 13.2%. So there seems to be some discriminatory power here for sure, but those are just odds and there are distributions and averages, and it's not the law of physics here, it's just a distribution. So let's see where we end the month of January. We're only on January 12th here, and the returns that you saw on the table are as of the close of January 11. So it's still very early in the year. Depending on where we end the month in January, that could give us an idea of the kind of markets that we could have, or at least we'll follow. We'll see how sentiment has evolved through the month of January, how it moved, how the pricing of the Fed evolves through the month of January through that. So there's going to be a lot of factors, but yes, maybe I think here it shows that we should care how we start the year, but it's just averages and distributions. It's not deterministic. So we will be keeping you posted here, but we are expecting a positive year, although a volatile year, but a positive year for equity markets and bond markets in 2024. So what to watch next week here in Canada? We'll have the Bank of Canada Business Outlook Survey. We'll have housing starts. We'll also have CPI inflation, which should be a bit lower month over month, but higher year over year because of the year over year effects. And retail sales should be going sideways for November. In the US, retail sales should be strong in December. Industrial production should be weak. Building permits, housing starts, and existing home sales much going in different directions. So no real direction for the US housing market to start the year. So that wraps it up for the week. ia.ca/economy. You can find this review. You can find the podcast there. iagam.ca/insights. We just published the January 24th edition of the monthly macro and strategy. So you can go there where we discuss the Taylor rule in this month's edition. The Taylor rule is the academic rule that is usually used to gauge the direction of monetary policy, or at least where the Fed rates should be given the economic fundamentals. And the signal that we're getting now is that this has turned around and it's starting to get to be time to get to cutting in the US. So you'll find the conclusions there. So that wraps it up for this week. Always a pleasure to serve you, and I'll be back again next week.